Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And on today's show, Gabi and I dig into mindset around debt. So we tackle the kind of idea of like, should you even pay down your debt? How should you be thinking about that? We talk about how to think about banks as business partners, how to think with an expansive growth mindset versus a scarcity mindset. We talk about abundance versus scarcity quite a bit. We really dig into how to think about all this kind of stuff. Now, there is no one right answer to this, and your situation is going to be unique to you. But if you want to tackle a different way to think about debt and how to manage that and how to achieve greater levels of freedom, choice, and abundance in your life by leveraging more, getting bigger, thinking more expansively, achieving more, doing more, having more, all of that kind of stuff, then this is the episode for you. So without any further ado, let's get stuck right into it, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. On today's show, you got both Goose and Gabi. Gabi, what's going on?
Woohoo! It's a couple of buds hanging out.
Couple of buds.
Couple of buds.
Couple of wealth-building buddies hanging out. What's been going on? What's happening? How are you?
What's happening? I'm good. I feel really happy today. We did a bit of a webinar event yesterday, which was really fun.
Secret webinar only. Invite
only, guys. But it was really awesome. It was cool.
It was a vibe, that's for sure. It was like a party. It was a vibe. It was a total vibe. There was a party going on. So we did it on the day that the RBA increased the cash rate by 50 basis points, which was the biggest single cash rate change in 22 years. It's pretty crazy. And it was still a vibe. It was still a bloody party. It was awesome. So, that says something. So anyway, we're not here to talk about that though. What's the vibe today? What are we vibing?
What are we vibing? We're vibing. Look, a lot of people have kind of hang-ups about debt, the concept of debt, having a lot of debt. I think, I don't know, it's part of the Australian culture, I guess, and just, how we're raised to like not have any debt, and we've kind of touched on this before, but we wanted to kind of dig into like a different way that you can think about debt and how that fits into your portfolio strategy and how, you don't always need to really focus on reducing your debt when you're purchasing the right asset, really.
Yeah, totally. It's a pretty good one, right? Because you're right. A lot of people have an aversion to debt. They think that the goal is, we often get told, like, I guess probably a more, I'm going to say an older way of thinking, but take it however you want. It's kind of like traditional. That's right. Traditional. Yeah. Old school, maybe way of thinking is basically get a job, buy a house, pay down the debt on your house, and that's success. Like that's what it's all about. That's the goal. That's what you should do. That's like, I'm just going to say it plainly. Like, yeah, absolutely do that if you're only aiming for mediocrity. And I mean that. It might sound a little controversial for me to say that, but to be honest, that is not going to lead to an exceptional life. Now, you can have a fulfilling life, right? Absolutely, you can have a fulfilling life. You can have a great life that meets all of your security needs, raise a great family, contribute to your community. You can do all of that kind of stuff. I'm not saying it wouldn't be necessarily a fulfilling life, but certainly wouldn't be an exceptional life, right? And so to that degree, it would sit in the middle band of mediocrity, in my personal view. Now, as we're talking about debt and stuff, it's really important to understand, firstly, no two people are the same. So what I might say is my opinion and my view and all of that kind of stuff. And it might be different from you. And I cast no judgment or dispersions on you for whatever you desire in your own life. The second thing is we are not licensed to give financial advice. So anything that we say on this show is our opinion only, right? And you should always go and get your own financial advice based on your own specific personal situation. So, that's with all of that being said, I think it's a really great topic because, if you really look at it, the companies, the people, all of that kind of stuff that get the highest levels of success, and I use that term lightly because success means different things to different people. For some people, success is having $50,000 passive income and just not having to work again, and they can just backpack around all over. Awesome. Don't get me wrong. That would be awesome, right? But when I'm in the context that I'm talking about, I mean like achieving greatness, achieving some level of extraordinary outcome. they all use leverage, right? Now, leverage comes in many, many different ways, shapes, or forms, right? But oftentimes they're also using debt as leverage. I mean, even if you look at Elon Musk, in his Twitter takeover, what's he using? Debt. The richest man in the world. What's he? All of his wealth, for example, is tied up in Tesla. Sometimes getting confused and say Telstra. He's not Telstra. Doesn't have Telstra shares.
Not buying Telstra.
No. So yeah.
5G.
No, so could help with Starlink or something somehow. Anyway, so he so he's got a lot of value in his stock options and shares and stuff in Tesla. And so how does he get that opportunity? How does he use that? He uses leverage. He gets debt, right? He gets debt against those. So even like the biggest, wealthiest people in the world are using loads of debt. Now, debt is not something to be scared of, right? Debt to be scared of, in my opinion, would be the debt on an asset which doesn't produce any income. That's gnarly debt. And so like some examples of that would be a car loan. And again, if you can afford it and you want to go and get a car loan, cool, great, right? But let's not pretend that that's good debt. That is not good debt. It is not income producing debt on an asset that is depreciating in value. Now, another example of bad debt would be on a principal place of residence. Now, you can argue that a principal place of residence is potentially going to go up in value and therefore it makes it an asset, but an asset should also produce an income stream, right? And so at the same time, sure, it might be going up in value, but if you're not producing any income from it, your capability to be able to tap into that value in that asset is going to be severely diminished because you might not have the borrowing capacity to be able to take it out anyway. So therefore, it could actually just be a complete waste of time. But if you've got, and I know that you want to say something, Gabi, and I know that I'm waffling, but I'm obviously pretty keen on this one, right? So, all right, the other, like an example of good debt would be, for example, an investment property which produces an income stream. And if you've got an asset which is increasing in value, or even if it doesn't increase in value, right, and it's producing income and it can cover the cost of its own debt and you've got no out-of-pocket expenses, who cares? Give me $1 trillion worth of debt that pays for itself. I'll be very happy. So I think that people are just going to reframe their position around debt. But anyway, before I keep going, what do you want to chuck in there?
Oh, no, I was just thinking about, I think a lot of people, listening to this are familiar with Robert Kiyosaki and, Rich Dad, Poor Dad, classic wealth building. It's one of the first books that people read that really changes their way that they think about wealth and property and, business and everything. How do you take what I have and leverage it in different ways to get a better outcome? Because everyone starts with a certain amount of resources, whether that's cash deposit, savings, income level, time. Some people have heaps of time that they can invest into. They can leverage their time into other things to build up their education and their knowledge, and that makes them more valuable to them, make better decisions, and that continues. But everyone starts in a position and then you leverage something into something that is greater. And so I think it's interesting with people really like Kiyosaki and understanding that concept of other people's money. So OPM being the fundamental, you hear that and you're like, well, that sounds awesome, because you're like, I'll just take my money, but then I'll also use other people's money, which includes banks, right? So OPM includes banks. That just means that it's not your money, it's other people's money that you are using and leveraging to increase an outcome. You're getting an ROI from somebody else's resources. And so this comes into this debt play. So a lot of people like Kiyosaki and like that idea, but then on the other hand, the contradiction is that people are going, oh, I want to reduce my debt. But there's time and place for everything. Like you said about success, there is a lot of people that for success to them, it's debt, I want to be debt free. I, want to have no debts, no loans, nothing. I want to be completely paid off, which is awesome. But there's a time and a place to have that as a priority, particularly obviously when you're building a property portfolio. If you think that you can buy a property, pay that down 100%, and then buy another one and pay that down 100%, you'll never really get anywhere with that. You need to use the tools available, which includes loans and debt. Debt is a tool in this space, using that to propel your strategy forward. rather than just thinking, I need to reduce it. Be aware of it.
Yeah.
But understand that if you are buying properties, it's not usually the best focus early on.
Well, it's a zero-sum game versus an infinite game, right? So a zero-sum game in the context of like, I'm going to buy one house and pay it off, and or two houses or three houses. I'm just going to focus on paying down the debt. That is by definition finite, right? You are saying, I am going to draw the edges of the board, whatever that be, 1, 2, 3, 4, 5 properties, whatever it might be. I'm going to draw the edges of the map, and then I'm just going to color in the map, right? And that is a finite game, right? That is a zero-sum game. It means you're going to get to X, and that is it. Boom, done, complete. Versus playing an infinite game, right? And an infinite game is infinitely more interesting. Now, how do you get an infinite return on your money? Not 100% return on capital, not a 500%, not 1,000, not 10,000, not 1,000,000%, an infinite return on capital. How do you think you do that?
That's a tease. You're teasing.
I am teasing, but this is true, right? The way that you do that is with debt, right? So let's say you buy a property, and let's just for very mud maths here today, guys, right? So let's say you buy a property with, a 10% deposit, and let's just say it's 20% cost all in, right? Once you've got all the purchasing costs and all of that kind of stuff. Let's say you got 20% total capital into a property. Let's do some maths, right? $500,000 property, 20%, that's all the cash you put into it is $100,000, right? So now let's just say that property goes up to $600,000, right? Goes up in value to $600,000. If you then refinance, i.e., apply more debt to that property to take out that $100,000, right? You've got no money left in that deal, $0 in the deal. You got no money left in the deal. And so what that means is if you've got no money left in the deal, but you still own the asset, every single cent that asset makes from that point onwards is an infinite return, right? Because like you're making money off zero residual capital contribution, right? So you can create an infinite return. It is like wild. And then you can just do it again and again and again and again and again and again and again. Now, where people can get a little bit stuck with this, or where they potentially come unstuck, is by leveraging too hard for too long, right? So this is absolutely not an argument to say that you should max out everything all the time, right? Because that actually is not going to be very good for your portfolio. So let me give some context to that. Let's just say you buy properties at 90% LVR, right? Or we use the same context, you put 20% total cash into the deal, right? And let's just say in the case of we've just used the $500,000 property, it's gone up to $600,000, and then you take all the cash out. Great. And then you can use that $100,000 to then go buy another property. Let's call it a $500,000 property. Great. You put $100,000 in, it goes up by $100,000 to $600,000. You take the cash out, you're right, and you move. What you're doing there is you're taking the same capital and you're repositioning it to continue to buy more properties and more properties and more properties. So you're taking the same amount of money and you're buying multiple properties with it, right? And creating an infinite return cycle off the back end of it. Now, if you went back to property number one, and let's just say over another 12 months, it grew by another $100,000, and then you take that $100,000 back out again, and you're essentially continuously shaving that property down to the bone every year, right? After a while, that's going to become a very sick property, right? After not that long. Now, when I talk about a sick property, what I mean is that the debt is going to become, the cost of debt and the cost of holding that property is going to become significantly higher than the income that is produced by that property. Now, you can offset that by other cash flows in the portfolio, right? So if you have one or two properties where that's the case, where you've done that and the cash flow has gone negative, but you're taking out tons of equity, it's growing well, and you're using that equity to buy more cash flowing assets, etc., and then you're pumping that cash flow back to redistribute that across the portfolio. So on net, your portfolio is neutral or positive, right? That's all good. But if you do that with every property in your portfolio, you won't have that outcome because what's going to happen is all of your properties will sink too negative in cash flow, and you're going to end up with a cash deficit in your portfolio, and that would be really unhealthy. What you'll be setting yourself up for there is a very high risk situation where if anything goes wrong, you're going to be massively highly leveraged and your portfolio won't be producing enough cash to take care of itself. Okay, so I'm absolutely not saying every chance you get, refinance every dollar you get out of every one of your properties, and off you go. I'm absolutely not saying that, but I am saying that you can actually use debt to actually massively accelerate. I mean, look, our portfolio, we've only put in 100 grand, right? And our LVR, I think, is at like 72%, right? Yeah. And we've only ever put in 100 grand to the whole portfolio, right? And that's crazy, right? And here's the other thing, because a lot of people then think, well, don't I need to pay down my debt? And when should I pay down my debt? And to be honest, you kind of don't need to. You can just give it enough time of doing nothing, right? So let's just say you have a general thesis in your portfolio that you're going to refinance all of the equity out of the properties only twice or something like that, right? And that's maybe a healthy amount or something like that. If you just leave the properties alone and do nothing over a couple of years, the LVR is going to reduce. It's going to reduce massively because the value of the property is going to go up, and the loan to value ratio will change, right? And so, if the value goes up and the loan amount stays the same, then the LVR goes down, right? So given a 5, 10, 15, 20, 25, 30, 40 year, 50 year time horizon, you could easily go from a 90% LVR to an 80%, to a 70%, to a 60%, to a 50%. You could get that almost down to, you wouldn't get it to 0% because you still have some debt on it, but your debt will stay the same, but the value of the property will change, right? And so if you think about the fact that, the national median house price in 1980 was about 75 grand or whatever it was, right? If you had a 100% LVR loan on that property, it would have become a 1% LVR loan in about 12 years or 13 years, right? And so all you need to do is give it a little bit of time for the value to change in the property, and your debt levels are going to change. Anyway, what do you think about that?
That's good. Yeah, I was just thinking about our portfolio as well, and I was thinking like my personal preference is to have just marginally cash flow positive, because that's again for our situation.
Yeah.
If it's just cash flow positive enough where the rent covers all of the mortgage repayments, all of the expenses, the operating costs for that particular property, if they operate in a silo and they're just marginally cash flow positive, then that's kind of like an indication for me that you are using the right amount of leverage. It's kind of like once it dips below negative, because that doesn't suit our strategy, that's kind of when you should stop, kind of just keep refinancing out.
Yeah. 100%. Right. And so there's a couple of ways to think about that as well. So then you've got the kind of like interest only versus principal and interest. Now, the principal and interest loan scenario, the concept of that is that you're going to be paying down your debt over time. And what we're talking about here is the fact that you actually might not need to, right? So if you think about the cost of capital, right? So let's just assume that you've got a 4% interest rate on your mortgage at the moment. Paying down your debt is going to give you a capital return of 4% a year, right? Because you're going to be reducing your debt. The cost of debt is 4%, right? So for every $1,000 that for every $100 you're putting into paying down the debt, you are making a gain of $4, right? So for every $100, you're making $4. Really simple maths. That is the cost of capital, is that $4. Now, if you reposition that $100 and put it into another asset, could you beat that hurdle rate of $4, right? So I would suggest that you probably can, right? Particularly if you're going on an interest-only basis, because the cash-on-cash returns are going to cover that expense anyway. Plus, also the interest component of your debt on an investment property is tax deductible against your marginal tax rate as well. So you get the additional benefit there. Now, here's an interesting thing, and I thought this was actually a really interesting trigger. I was speaking to Chris Raymond the other day, actually on this podcast. If you haven't listened to that episode, go check it out. It's a couple of episodes ago. And I asked him this question. I said, because he has all of this stuff is on interest only. And I said, would you keep it on interest only forever? And he said, no. And I said, oh, that's really interesting. Why not? When would you change? He said, and I thought this was a really great insight, and this is why it's worth repeating again. And this is just one perspective. He said that he would switch his investment properties to principal and interest only when his investment properties have paid off his principal place of residence, right? So he's got his principal place of residence, right? Which is bad debt because it's non-income producing debt, right? And so his property investments are all on interest only. The cash flow from those property investments goes into paying down his bad debt as fast as possible, his non-income producing debt as fast as possible, right? And so then once that's paid off and he's got no more bad debt, well, then all of the other cash is surplus. And at that point, it might make sense to start paying down the debt. Now, there's two ways to think about that. You could either say, sure, it might make sense to pay down the debt, or in fact, it might make sense to actually just go get more investment properties, right? So there's two ways to think about it. But it's really interesting to think about, like, what is that trigger for any one individual? And I thought that was a really good way of thinking about it on an individual basis. I would still argue that if I could never pay down the debt and only ever pay interest only for life, then I'd probably choose that, because I'd choose to be a debt millionaire, right? So,
yeah, I think it's interesting, right? Because I hear the word debt and I think of Charlie. So our client Charlie obviously has been on this podcast many times, but I know that I'm pretty sure when they all of their properties that they bought with us initially were principal and interest, right, from memory.
Yeah.
And so I know that now, how many have we bought with them? 3 or 4?
Not sure. I'm not sure.
But I know that they got to a point where it was like, I've got all this equity because I've been paying P&I, and there's all this equity in
the properties have been growing, right? And the properties have been
growing. That the LVR was down to, like, I don't remember,
low.
68%
It was low,
or something. It was really low.
Yeah.
And then it's like, well, what do I do with that? Like, and they're just going to end up refinancing that out and keep going. So they didn't have to put it in as principal through payments. Yeah.
So rather than locking up your capital on the balance sheet, keep your profit liquid, right? So, and it's a big trap that I see a lot of people getting into, because they end up being massively equity millionaires versus being, asset millionaires, right? So, and I think that there's a smarter way to think about it. I like to think about scale, right? And so if I get to your point and to Robert Kiyosaki's point, using other people's money, it's like, if I can use more debt, right? And that allows me to get to 10, 15, 20, 30 investment properties, or maybe put it in a different way, allows me to buy 10, but maybe some of those are unit blocks or whatever the case may be. If it allows me to build a bigger, more significant portfolio versus I'm only going to use all my own money, and I don't want to go into debt or go into effectively a partnership. Because the other way to think about debt, right? The other way to think about debt is it's kind of like a partnership. Now, it is giving some degree of ownership over the asset to another individual, right? So it's almost like saying, if I wanted to go and buy a $10 million block of apartments, a unit block somewhere, right? I don't have 10 million bucks, right? So what are my options? My options are go find someone who's got, the balance of the cash, pretty much 10 million bucks, because, I don't have that much money. So find someone who's got the cash to buy the asset, right? And so go say, hey, do you want to go into business with me? And I'll give you a proportionate share of ownership based on how much cash you're going to put into it. Or do I find someone who wants to effectively go into business on a part-time basis and make money in a different way, right? And in that situation, I'm saying go into a bank or a non-bank or whatever the case may be and say, hey, would you like to go into business with me? I've found this asset. It does X. It produces X amount of income. I'm going to put in this much cash, and I'm going to take the ownership over being responsible for making sure that you're going to get all your cash back out of it in a certain period of time. Do you want to go into business? Great, right? And you take on a business partner. So a better way to think about it, rather than this kind of onerous debt conversation, which has negative connotations. Oh, you're in debt. Debt is bad. All this kind of stuff. It's actually more like a partnership. It's like, do you want to be a capital partner on this journey with me and help me to get a portfolio? Because I can absolutely tell you, Blackstone, huge, big private equity firm that own hundreds of thousands of houses, they don't have the money to buy all those houses. They don't have the money to buy all those houses. They do not have that much cash. What they do is they go raise a fund, right? And they say, hey, guys, we want to go and buy 100,000 houses. Who wants to go into business with us? Give us your money and we'll give you this kind of return. So they go and raise capital. And then what they do with that capital is they then go to a bank, all right, and they say, hey, we've now got all this capital from all these other people who want to go into business with us. Do you want to go into business with us too? If you give us some money to put into this fund to buy 100,000 houses, we'll give you this much of a return. How does that sound? And the bank says, yeah. So effectively, they go into business twice to achieve that outcome. They're not just swanning around with wallets full of cash going, well, as long as I don't go into debt, this is going to be good, because they'd end up with about 3 houses and they'd get nowhere, versus being one of the largest, investment firms on the planet, right? So It's all about perspective, I think.
Yeah, it's reminding me actually, like when we very early days in the business, where we were starting to educate people on how this all works and how you can not get stuck in a portfolio and how to leverage it, and the real early stuff that you learn when you learn about property. And I remember I used to explain it like, think of it like the bank basically owns the property, right? You technically own it, but they have controlling interest, right? So think about it like they own, whatever the LVR is. If it's 80%, they own 80%, you own 20%, right? Think about it that way. And it is in that like business partner mindset. Like, they own 80%, you own 20%, but you get 100% of the cash flow and you get 100% of the growth. So if you own 20% today, they own 80%. If that grows, I'm not going to do this math, but if it grows by 10%, then you get that 10%. The bank doesn't get the 10%. You get the 10%. And then so that evens out, but you get all the cash flow. And then if you want to leverage more out because it's grown by 10% and you've got that extra, you then go to the bank and basically like sell a portion of your share back to them and go, hey, it's grown by this much. Do you want to buy this a little bit more? They go, yes, cool, I'll do that. And then that's how you're leveraging cash back out to buy another thing. And so, that's interesting that you're talking about that business mindset, because it is what it is. And I don't think enough people think about it. People want the emotional, like, this is my property, I own my property, and the bank's just this like kind of annoying devil thing that's like pretending that they have control, but it's like they're a partner. Like you wouldn't have, not many people have the cash to be able to go out and just buy properties in cash. It's not very common. People do it, obviously, but more often than not, people rely on banks to buy properties. And so if you're thinking about it like, I have this amount of money, this will buy me 10%, 20%, 30% of a property. I'm going into partnership with a bank. That's just how it works. It's a partnership.
There's loads of different ways to structure partnerships, right? So if I've got a business, right, I could, and I want to grow that business, or I want to buy another business or whatever, I've got options, right? I can go to, let's just say, a private high net worth individual, right? A high net worth individual who's got plenty of cash. I can go to them and say, hey, do you want to go in on this with me? Do you want to stump up the cash, right? If you can stump up the cash, I'm going to buy this other business. And then they're going to say, great, what do I get out of it? And either they want a specific return, and there's different, or they could say, no worries, like I'll lend it to you, but I want a guaranteed return. And so there's all these different ways of structuring these kinds of deals, right? And even debt has got many, many nuances. But I think that's probably a way better way of thinking about it, is that kind of partnership perspective. The other way to think, and like I think the other thing to just kind of loop back on this as well, is that just a reminder that if you buy assets, right, that are good assets that are going to grow and produce enough cash flow, you don't ever personally need to be responsible for paying down those debts, because the properties will do it themselves. So you don't even need to worry about it, right? And there's this whole kind of like mindset that comes from most people's upbringing, which is like, are you a good saver? Are you, smart with your money? Do you reduce your debts? Do you do all that kind of stuff? And I think that puts these kind of constraints on people on how they think that they should behave, versus saying, well, how do I get smart, right? How do I achieve more with less impact? So rather than trying to budget and save and be like, oh, I'm going to buy the no-name toothpaste because it's 20 cents cheaper than the brand name toothpaste. Look at me, I'm a saver, I'm a budgeter. Don't get me wrong, being smart with money is good, but at the same time, you don't want to get into a scarcity mindset around it, right? What you want to get into is a smart mindset and think about, how do I get more? How do I achieve more? How do I have more, right? So rather than thinking, how do I reduce, think about, how do I expand, right? And if you can expand, then that's going to solve all of the problems, right? So you can expand your portfolio, generate more cash flow, and then you don't need to worry about picking the cheap toothpaste. You know what I mean, right? So thinking with an expansive growth mindset versus a scarcity reduction mindset, this is going to change the way that you think about how you live your life and your portfolio. So rather than thinking, how do I save money? How do I cut expenses? How do I reduce debt? All of those things are inwardly contracting, down, small, think, little, let's go small, let's go subtract, versus how do I add? How do I grow? How do I increase? How do I increase my standard of living? How do I go out to nicer restaurants? How do I achieve that within the constraints that I've got? Well, I might need to expand my income. I might need to expand my net worth. I might need to expand my exposure. I might need to expand my portfolio, because you can have whatever you want in life. Absolutely, whatever you want in life, all you need to decide is what it is and go and get it. Right. And so if you shift your mindset from a scarcity, inward facing, downward facing mindset into an expansive growth base, you'll achieve more, see more, do more, have more, and achieve greater levels of success in your life. And part of that is thinking about how do you expand all this stuff, and that's how it relates to debt as well. So,
yeah, it's really cool that you brought that up, actually, because I think that is one of the biggest mindset shifts that happened for us that has resulted in us being in the position that we are and having this amazing business that helps other people, is that shift from, instead of focusing on how do I reduce the cost, you focus on the other side of the equation, which is how do I increase the income? How do I increase the upside? How do I increase, expand, like you're saying?
How do I bake a bigger pie?
Yeah, rather than like, how do I reduce? And it's the scarcity versus an abundant mindset. And I think that, like, personally, I think as soon as we kind of like learned that and really like started living that, so much changed. And so much does change for people as they start to go, okay, what else can I do? How can I think bigger? How can I be more and think more, expand bigger, rather than, shit, I've only got these resources. I don't want to lose them. I'm going to like stay still and stable and not take any risks and just try and like minimize any shake to that. Stop focusing on that and think about, how do I use that and do more with it?
Yeah, because it's really interesting, right? Because on a metaphysical level, your actions will create your reality, right? And so the trick is, even when you don't have much, even when you think that you might be in a state of scarcity, right? When you literally might not have much money, you need to go out and you need to live as if you are abundant, right? So what that means is you need to give, right? You need to, if you are worried about money right now, if you think, I don't have enough money, I'm scared, there's not much money in the bank account, I'm a bit worried, it's payday's a fair way away or whatever, go and take some of that money and go and donate it. Go and give it to a charity that you care about. Go and give it to someone, right? You will feel a shift, an energetic shift, right? The moment that you start giving, right? Because giving is the first step to receiving and first step to growing, right? Then you also need to think, all right, I'm going to treat myself. I'm going to take myself out to a nice dinner, or I'm going to go buy that fancy dress, or I'm going to go do that thing, or you've got to start walking into the future that you're creating. It's the only way that you can actually do it. And then the abundance will start to come back. But you have to act with a growth mindset, because you can't trick yourself. You can't lie to the way that the way that you are internally. And it's an internal game that expresses itself on the outside. So I think it's absolutely critical that people start to get their mindset right around this stuff.
Yeah. And I mean, you and I can get pretty woo on money mindset. So I'm keen to know if you guys are interested, and maybe we'll do another podcast on more of this side of things. If you're not interested, that's cool. Hope you've enjoyed the episode. I've got a question before we kind of wrap up.
Okay.
I think people, obviously we've talked about like there's a bias, and we're kind of educated as we grow up in this country to think about reducing debt and being a good saver, and saving is good, but the debt piece, how can people think about that from a risk perspective? Because I think particularly like there's a lot happening in the world. There's a lot of changes, rates, inflation, blah, blah, blah. A lot of like the common kind of noise is that if you have a lot of debt and then, interest rates go up, or there's a lot of change in government, like there's a lot of things that people feel having a lot of debt seems risky. Like, how can people think about that in this kind of environment?
Yeah. So it's a good point, right? So how do you manage risk? So risk comes from knowledge, right? And understanding, right? So the more that you understand something, the lower the risk is, right? If you need to get open heart surgery, right? and the person doing the surgery has never done the surgery before, hasn't trained to be a surgeon, doesn't know one end of the scalpel from the other, all that kind of stuff, the risk of you dying on the operating table is pretty high, right? Versus someone who has 30 years of experience, has seen it, done all that kind of stuff, has loads of knowledge, right? So risk is a factor of knowledge and understanding. That's literally it, right? The more that you understand a topic, the easier you can manage the risk, and the lower the risk, the relative risk is, right? Same thing goes with debt and property and all of that kind of stuff. So if you don't know much, right, and if you listen to the media, right, then, you might be thinking, well, I need to reduce all my debt because what if the housing market crashes? What if it crashes by like 30 or 40%, right? I don't want to go into negative equity. But you've also then got to actually look at the situation and go, okay, what is the actual risk? Now, I don't have the stats in front of me right now exactly, but I think that the largest downturn that we had in the property market in Australia was 10, maybe 15%. Right, it was the largest downturn that we've ever had. I think it might have only been about 10%. Right, so
over
all of these people
period?
Over a few years, right? Yep. So, but that's like the largest that we've ever had, right? So you've also then got to take into consideration, if you hear all these doom and gloom reports, right? Housing markets are going to crash by X. It's like, is it really going to crash, be the biggest crash that we've ever seen in the history of ever? Look, potentially that happens, right? That kind of stuff does happen. But you've also then got to weigh up what is the actual risk and likelihood of that happening to your specific assets, why, all of that kind of stuff. And so I think it's situationally dependent. I mean, certainly, if somebody bought in Sydney in, let's call it late 2021, and they bought on a 95% LVR loan, then yeah, they're probably going to go into negative equity, right? And that would be a high risk situation. But there's many other situations where you'd be in a very low risk position to do that. So it's really about understanding what your risk tolerance is, what your understanding is of the market, how to get more educated, how to partner with the right people, all of that kind of stuff. Personally, I don't see much of a capital risk at all, particularly for ourselves and the properties we bought and our clients and all of that kind of stuff. So I don't see it's a very high risk kind of thing at all. But it does depend on what you're buying, where you're buying, and what your understanding of risk is and what your risk appetite is. Did I answer your question effectively?
Yeah, I think it like most things that we talk about comes back to buying right property, right place, right time, right?
Mm-hmm.
And understanding, so much of this is about building your knowledge and hopefully what we share on this podcast is helping people to do that and to think differently about it and to think like, how do I, again, focus on the expansion piece?
Yeah. I want to throw a few more things in there because I had a couple of seconds to think about it there. So let's just say that, the property market shits the bed and you've bought a property and then all of a sudden you go 10% negative equity. What's going to happen then, right? What is going to happen then? If you have bought an asset, right, which produces more income than it uses, probably nothing's going to happen, right? Because you're still going to hold the asset, right? And until you sell the asset, you're not going to realize any of the loss, right? So you've still got the asset, you still control the asset, you still got the income coming from it, right? And probably the incomes are going to be going up because more people are going to want to rent because they're going to be thinking the property price is no good and all of that kind of stuff, right? So it's probably actually going to work inversely better. Now, you've also got to remember that even if it did crash, even if we did have a complete total collapse of like 20% or something like that, it's not going to last. It's not going to last. It will come back up, right? So even in the GFC, when it crashed massively, property prices went back up. And even in 2017 to 2019, property prices went back up. So as long as you can afford to hold the asset, then you're not going to be in a position where you're going to be struggling. Now, banks, if there is a big crash, banks aren't going to want to try and call in loads of bad debt because they are going to have to realize the bad debt as well, right? So you've got to think about that. Now, there's a big difference between somebody not paying their mortgage, right? An individual not paying their mortgage, getting behind in their debts, and the bank saying, you know what, actually, we're going to foreclose on your house and reclaim the house, versus, 1 million people or 10 million people with their houses underwater. The banks can't afford to call in all those loans, right? They can't afford it because then they have to capitalize on the loss. They would be screwed, right? And so, there's a saying, and I'm going to butcher it, but it's like, if I've got $1 million of debt, that's my problem. But if I've got $1 billion of debt, that's somebody else's problem. You know what I mean? Or something like that, right? So to a certain degree, if it's kind of happening on that scale, like the risk is actually lower, right? Because nobody wants to capitalize on that loss, and it's probably going to bounce back, right? So I would suggest that like having a steady hand as you go through these kind of environments is critical as well. And understanding that it's like, if all of our assets if they went down by whatever, 20, 30% right now, we'd just hold them. We'd just hold them. We'd just keep holding them, because what's the point in capitalizing on the loss? Zero. And they produce enough income to cover all their expenses. Okay, cool. Great. So like, even that's not something to be scared of, in my opinion. So that's, I just wanted to throw that in there as a way to think about that.
Yeah, it's the same like if you look at like shares, right? The fluctuation in share price changes by the minute, basically. But if you sell when it goes down because you freak out and you're like, shit, it's going to tank. Like this is a downward trend looking at the last 5 minutes.
Yeah.
Look at where it was, look at where it is now. It's going down. So I'm going to get out before it goes lower. If you sell at that point, you've lost. Like you have lost, depending on when you got in, but assuming it's less than what you bought it for, you've lost, right? But if you don't sell at that point, if you write it out, that fluctuation means nothing to you, you know?
The difference being that your shares probably aren't producing enough income, right? And so you're in a net negative position, right? So yeah, totally. And the other thing as well is like, just going back to it, it's like property should not be a short-term game, right? It should not be a short-term game. Yep. You know, you want to be hanging on to your properties for multiple years, and rate rises don't last forever. They've gone up before, right? They go up and then they go down. And like typically it's like 2 years or something like that. Property market downturns, they have happened, they do happen, and then they bounce right back up and they go to record, they achieve new records as well. So all you need to do is stay in the game, right? And that is not a reason to think small. That is actually a reason to think bigger, right? Because as these things rebound, and if you can keep pushing forward when other people are contracting, you're going to be setting yourself up for even greater levels of success when you come through the other side. So, yeah.
Yeah. And people adapt, right? I think we forget how adaptable we are. If you do end up in a position where, you know, you might have bought the wrong property or something has happened and you need to sell it, you adapt. Like you can sell, you can put that money somewhere else, you can adjust. Like we are designed to survive anything. That is how we're built, is to survive and to adapt. And so it is not the worst thing in the world if you get to a position where you need to accept like, okay, that was probably not the best investment. Let's do what I can in this moment to keep moving forward, whatever that involves. And then you just learn and you keep going. Like it is not, I think so many people get caught up in like trying not to make mistakes. Yes, there's a like, it's one of the largest purchases that people will make, but you can still, you adapt. Like if you kind of take your ego out of it, you will learn, move on, learn the lesson, try again. And that's how we continue to grow. So
yeah, 100%. And yeah, I couldn't agree with that more. I think we've covered a lot of ground on this episode though, Gabi. What do you reckon?
We have, yeah.
Awesome. Well, why don't we leave it there? And to Gabi's point earlier, if you want us to do some more episodes on mindset, money mindset, all of that kind of stuff, then we're really into that kind of stuff. We love a bit of the woo, with a bit of the wealthy woos. So if you want some wealthy woos, just email wealthywoo to to til@dashdot.com.au. That's wealthywoo. Just send that in the subject line, or in fact, send us a question that you would like us to answer, or let us know if you would like us to talk more about mindset, money mindset, and how to overcome those challenges and those fears to think bigger and live a more prosperous and abundant life. Do that by sending us an email to til@dashdot.com.au. We look forward to hearing from you. We look forward to seeing you on the next episode. Thanks, guys.
Cool. Bye.